Again, my name is John Paul Ruiz, Director of Professional Development here at the Entrust Group, and welcome to the seminar why you need to be aware of at year end. We just created this particular seminar to remind individuals of the things that are happening year end that is associated with your IRAs. And again, my name is John Paul Ruiz, Director of Professional Development here at the Entrust Group. And before we get started, just want to let you know that the Entrust Group does not provide investment advice nor endorse any products. One of the main things that we focus at the Entrust Group is education or information to assist our clients in making informed decisions in regard to their IRAs or retirement plans with the Entrust Group. All information materials are purely for education purposes only. All parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment, or if there's a transaction that they need to get to be familiar with. Well, the tax or legal or investment advisor will be the people you need to consult with. The Entrust Group does not provide tax, legal, nor investment advice. What's the agenda for today? We're talk a little bit about the Entrust Group. What is a self-directed IRA for those of you who are attending one of our seminars for the very first time? The benefits of self-direction. And then we're going to dive into some of the things that are coming up in year end, such as what we call qualified charitable distributions available for individuals that are age 70 and a half and older. Again, required minimum distributions as well. We're going to take a look at fair market valuations, which is a requirement for the grantor of the trust, meaning the IRA holder, to provide their custodian the necessary fair market value so that the custodian can actually perform their IRS duties. In other words, the reporting duties that the custodian would have to provide to the Internal Revenue Service. Last but not least, we'll talk about Roth Conversions. There's certain individuals who are trying to capture the opportunity to convert their traditional IRA assets to a Roth IRA. And year end is a very important, significant date, for them to be able to make that conversion count for a particular year. Well, let's get started. This particular presentation will last approximately about a half hour to 40 minutes long. We'll devote the last 20 minutes or so of the presentation to answering any questions you may have. A little bit about the Entrust Group. We've been around for nearly 40 years with over 22,000 plus accounts and more assets than the 22,000 accounts, because some of our account holders carry more than one asset in their IRAs. We administer over $3.3 billion in investment assets. Entrust was one of the few institutions that do have a live people that you can speak with in regards to opening up a self-directed account. We do have individuals in certain strategic locations in the United States, such as the East Coast, Midwest, as well as the West Coast. Since we are located in the West Coast, there's a little bit more presence the Entrust has in the West Coast. Not only do we provide administration, in other words, record keeping of self-directed accounts, we also provide custody services. We do have another organization that is a separate organization, but for regulatory purposes, it's called the Entrust Trust Company that custodies the assets for us. But one of the main things we provide at the Entrust Group is education. Not only do we educate our own staff, but we also educate practitioners, in other words, attorneys, CPAs, CFPs, certified financial planners out there, as well as we also educate the industry, including but not limited to competitors, as well as other organizations that you might deal with. In other words, our educational opportunities are available for CE credits for the certified financial planner. We are an approved continuing education provider for the IRS, the National Association of State Boards and Accountancy, in other words, for CE credits for CPAs, and other designations that are not listed on the screen. Now, we are a self-directed IRA administrator. What does that mean? Unlike other financial institutions that actually offer investments and they offer IRAs to allow for individual IRA holders to invest in the investments that they offer, a self-directed IRA is an open architectural model. In other words, we don't offer any investments, but we do offer the documentation as well as the administration for the IRA to keep the IRA tax deferred, as well as custodial services, which, in other words, we basically hold the investment on behalf of the IRA holder to keep that asset tax deferred under the IRA. In other words, in IRAs, if you take that investment and put it under your name, that's what we call a distribution. It becomes taxable. Somebody has to safekeep or take custody of those assets, and that's one of the services we perform at the Entrust Group as part of our program. But we do not offer any investments. Now, what's the difference between that and any other IRA provider? Number one, we don't offer an investment, but we do allow for individuals to seek out the investment that you like. And as long as it's allowable under law, we will custody it or hold it under the IRA that you have at the Entrust Group. The different types of IRAs we offer include traditional IRAs, Roth IRAs, SEP IRAs, or simple IRAs, as well as individual 401k plans. But mainly the focus of this particular course are IRAs. So we offer traditional Roth, SEP IRAs, and simple IRAs at the Entrust Group. These IRAs are regulated by the Internal Revenue Code. Therefore, it still follows the same rules as any other IRA you may have at another financial institution. The platform, again, provides and offers administration and custody of the investments, but we do not offer the investments. What does that mean? If you want to buy a piece of real estate under your IRA, absolutely, as long as it doesn't violate any sort of the violations of the law, such as prohibited transactions, we will custody those assets on your behalf as part of our offering, as part of our program. But we, again, do not offer any investment. A self-directed IRA is not a type of IRA. It's nothing more than an IRA that is basically held under a platform, a custodian that has a platform that does not offer investments, but allows for individuals to seek out and do their own due diligence with their competent legal, tax, or investment advisor to hold that investment under the umbrella of the IRA that they hold under the self-directed IRA administrator. Why is that an important tool? Because it allows for greater asset diversification. In other words, if you have an IRA at a broker dealer, which is a great thing, by the way, you will basically have stocks, bonds, and mutual funds. But does that diversify your portfolio? In some cases, it does not, because what if you wanted a piece of real estate or gold or silver under your IRA? Well, you have to seek out a custodian that will be willing to hold those types of investments under your IRA, and that's where the self-directed IRA administrator comes in. It's basically just an industry term for a custodian that does not offer any investments, but allows for the IRA holder to choose the investment they're choosing to hold underneath their retirement plan. Again, it's up to the IRA holder to do their own due diligence in regards to the type of investment they would like to hold under their IRA. And the Entrust Group does not offer investment advice. Benefits of self-direction, in a nutshell, it allows for you to take control, to make your own investment choices, because you're not limited to what the financial institution offers as an investment. But you, the IRA holder, can actually seek out the investment you choose to hold under the IRA. And as long as it doesn't violate any of the rules governing IRAs, then you could basically hold that in what we call a self-directed account. Number two, we've talked about this already. It allows for you to diversify the investments that you have in your retirement portfolio. You're not limited to stocks, bonds, mutual funds, CDs, the money market accounts, the normal standard traditional investments. You can hold, as an example, pieces of real estate, private placements, notes, liens. As long as it doesn't violate the prohibited transaction rules, you should be able to hold that under your self-directed account. And as long as the administrator is willing to be able to hold that particular investment and can record keep it, feasibly record keep it because of the nuances of a particular type of investment, it should be available under a self-directed IRA. In the retirement plans, what's the benefit of that? Why is it beneficial to hold it under a retirement plan? Because in a retirement plan, the earnings do grow tax deferred. Although there are limitations of contributions, once the contributions are made into An IRA, you have an ocean of investments available to you and not limited to what the financial institution will offer. Contributions in some IRAs may be tax deductible, such as your traditional IRA. And if you're an employer, you want to make a profit sharing contribution to use it as a tax deduction as an employer, then that's where the SEP plan comes in. In other types of IRAs, mainly the Roth IRA, not only does the assets grow tax deferred, later on the earnings may even be distributed tax free if you satisfy certain criteria. Mainly, if you've had a Roth IRA for 5 years. When I say Roth IRA for 5 years, that means any Roth. The moment you contribute to any Roth, the clock starts ticking for all of your Roths for the rest of your life. In other words, the moment you satisfy the 5-year clock, which by the way begins as of January 1st of the year for which a contribution is made. So in other words, right now, if you make a contribution to your Roth IRA for the very first time in December, your clock started ticking January 1st of this particular year. That's one half of the criteria to distribute your earnings tax-free. The only thing you'll be waiting for the moment you satisfy the 5-year clock are one of the four. A death. You don't want that to happen, but it could happen. What that means is that as long as you've had a Roth for 5 years, after you die, all your Roth IRAs are tax-free for the rest of your beneficiary's life. In other words, they can take incremental distributions out of that Roth IRA tax-free for the rest of their own life expectancy. Number two, 59 and a half. When you reach 59 and a half and you've had a Roth for 5 years, all of your Roth IRAs are tax-free. If you become disabled and you've had a Roth for 5 years, all your Roth IRAs are tax-free. And last but not least, up to $10,000 of the earnings can be distributed for a first-time homebuyer, and that $10,000 of the earnings will be tax-free. Now, keep in mind why we're not talking about the contributions, because contributions in a Roth have been taxed already, so those can be distributed at any time, penalty-free, tax-free. But in a Roth IRA, how are the earnings treated? If you've had a Roth for 5 years and one of the four, death, disability, attainment of 59 and a half, and up to $10,000 of the earnings can be distributed for first-time home purchase, and those earnings will be distributed tax-free. Now, there are significant things that are associated with having a traditional, a SEP, or a simple IRA. As you've noticed, I excluded the Roth in that. The reason for that is because Roth IRAs are not subject to what we call the required contribution rules. For those of you who are not familiar with that, the moment a person reaches the magical age of 70 and a half, in other words, if a person is going to turn 70 in the early part of the year, you know that they're going to turn 70 and a half, they typically have to distribute a minimum amount, a small amount out of that IRA, and that's where your custodian can actually help you in calculating that amount. That typical amount, the minimum amount, the small amount, must be distributed typically by December 31st. However, if it's your first year, you can actually postpone that up until April 1st of the year following. So in other words, if you're 70 and a half in 2019, although your typical deadline is December 31st of this year to remove your RMD or distribute your RMD, you can actually wait until April 1st of next year to distribute your RMD, and it's still timely. You only get that for 1 year. However, what you need to recognize is that if you wait until next year for your first one, you're going to have two that following year. For some individuals who are 70 and a half taking required minimum distributions, they're trying to minimize the amount of taxation or taxable income that they will receive to avoid effects on other benefits such as Social Security as an example. So therefore, you might want to check with your tax advisor in regards to what the effect is of that taxable distribution you might have to take out of your IRA. Now, it doesn't affect everybody, but it could affect some people. So it'd be a good conversation to have with a tax advisor, then at least you would know what that effect would be as far as taxability of that distribution as it affects other benefits such as Social Security. Failing to take out a required minimum distribution can result in a penalty. The penalty is 50%. The 50% is the amount of the RMD. In other words, if you fail to take out, let's say your RMD is 2,000 and you fail to take out 2,000, your penalty is 50% of that. In other words, 1,000. That has to be paid by the taxpayer with their tax return using an IRS form 5329. Now, here's the good news, however. If you fail to take the distribution out in a timely fashion and there was a reasonable cause, the IRS Form 5329, as part of its instructions, has a recourse for the taxpayer who fails to take a distribution like this in a timely fashion. What the IRS says is jot down on a letter explaining to the IRS what happened and attach that letter on the back of the IRS Form 5329 and put on the section of the 5329 dealing with required minimum distribution penalties that you have a reasonable cause. In other words, the acronym RC, and then the IRS will reserve the right to, still assess the penalty or waive the penalty based on the reason that you provided. Such as if you were sick, you couldn't take your RMD out. That's an acceptable reason. Maybe you may have been out of the country. A lot of people who are retired, I can't always assume that people are 70 and up are retired. Some people are still working. Let's say somebody's retired and left the country and they couldn't get back to take a distribution. That's a reasonable cause. Any reasonable cause, I would say take a chance and get that 50% waived. Now, failing to take out an RMD has a 50%. But if you take the RMD, keep in mind that RMD is includable as taxable income in the year of the distribution. So you kind of need to weigh out the repercussions, right? Either you pay tax on the distribution or you pay a 50% penalty. In some cases, depending upon the state that you live in, because some states have income tax and some states don't. By the time you pay the federal tax and the state tax, sometimes it's almost 50%. So it is a choice to either take your distribution or just pay the 50% penalty. Now, why are we talking about that? Because in some cases, individuals may have an investment that is what we call illiquid. Let's say you have a piece of rental property, or just a piece of real estate, and it's not earning any money at all. Therefore, you don't have the cash to distribute. There is an option to distribute whatever you can, and then just pay the 50% penalty on the rest. Some people think that if by having the required minimum distribution that you have to take out the RMD. I just want to say that it is an option under Section 4974 of the code. And when I say code, the Internal Revenue Code. So either you take it out or pay a 50% penalty. Some people say, you know what, I'll just pay the 50% penalty. We just want to let you know that that is an option. Now, for December 31st of 2019, individuals who may have passed away in 2018 who has beneficiaries, the beneficiaries have to make certain elections by the end of the year following the year of death. In other words, to determine what option they would like to take. They can either take little small incremental distributions called life expectancy payments, but that election has to be made by December 31st of the year following the year of death. Or in some cases where the IRA holder died young, in other words, they haven't started taking their required minimum they haven't started to take the required minimum distribution. Let's say they died at age 55. The beneficiaries have an additional option. That option is what we call the 5-year rule option. That also has to be affirmatively elected in order for the beneficiary to have that option. What that option means is that they don't have to do anything. The beneficiary, that's what I'm talking about, is the beneficiary does not have to do anything until the year that contains the 5th anniversary of the IRA holder's death. So in other words, if a person died in 2018, if they elect the 5-year rule option by December 31st of 2019, assuming it's an option, well, let's start counting. If a person died in 2018, the first anniversary is 2019, second 2020, 21, 22, 23, In other words, in 2023, the 5-year rule option says everything must be distributed. If it's not distributed by the end of the year that contains the 5th anniversary of the IRA holder's death, then that amount is subject to a 50% penalty. Now, that's the reason why beneficiary options are actually under the required minimum distribution slide, because beneficiary distributions are considered required minimum distributions. And if a beneficiary doesn't take their RMD, that amount that they've chosen to deplete the IRA that they inherited, well, that amount is subject to a 50% penalty. So what's the moral of the story? If you're in RMD stage, connect with your beneficiaries in regards to identifying for them what their available options are upon your death, so that it doesn't come as a surprise to them that they have to make certain elections upon your death. Conversations while you're alive is highly recommended. Talk to your tax or legal advisor so that the beneficiaries know what they're going to do upon the death of the IRA holder. There are a significant amount of wealth that have been accumulated underneath a person's IRA. Need to make sure that, number one, the beneficiary designation form is up to date, and number two, that the beneficiaries are aware of what their options are. We will bring you more courses in regards to RMDs and beneficiary options in future seminars, but today all we're trying to do is touch on what needs to happen at year end. Number one, people who are over 70 and a half have a typical required minimum distribution due. If they don't take it out, there's a 50% penalty. However, they have the option of paying the 50% penalty if they choose to, or if they have a reasonable cause on why the RMD was not distributed, they can actually apply for a waiver with the IRS, and that's through the IRS Form 5329. And lastly, for IRA holders that passed away in 2018, beneficiaries have a deadline of December 31st of the year following the year of death to choose whether or not they want to take small distributions called life expectancy payments, or in some cases, if it's available, the 5-year rule option, which requires for the whole IRA to be depleted by the beneficiary or beneficiaries, if that's what they elected, by December 31st of the year that contains the 5th anniversary of the IRA holder's death. Now, that's a mouthful of information I just provided to you, but please jot down copious notes as well as any questions you may have. We'll answer towards the end of the seminar. Another thing that's significant about the year end is that for people who are over 70 and a half, maybe wanting to, I would say just dump assets. In other words, deplete assets by giving their assets to a charitable institution. Individuals who want to make a charitable contribution using their IRA can give up to $100,000 per taxpayer, and it will be a tax-exempt distribution. In other words, it will not be subject to taxes if it's given again to a qualified charity, and it will also satisfy that individual's required minimum distribution. Again, this is only available for people who are 70 and a half or older, and that amount of distribution, it is paid directly to a qualified charitable institution. In other words, paid directly means the custodian can still cut a check, but the check has to be made payable to the qualified charitable institution. And that distribution will be exempt from taxation up to $100,000. If it's done, if the distribution is distributed by December 31st of this particular year. In other words, you want to do a qualified charitable distribution because you want to lower down the size of your estate. Well, that distribution has to occur by December 31st of this particular year. Now, given the fact that custodians are required to provide a fair market value of each individual's IRA by January 31st of the year following the calendar year, custodians who do not have the investment, who did not choose the investment in their IRA, will be requesting from IRA holders a fair market value of the investment that they have under their IRA. In other words, in a self-directed account, there will be a notification to IRA holders from custodians requesting what is the fair market value of your IRA. In other words, you have to provide documentation of what the fair market value is of your IRA so that the custodian can do their job. In other words, satisfy their regulatory requirement to provide the fair market value being held under the IRA, under the custodian, to the IRS. Fair market values amounts are due to the IRS and the IRA holder by January 31st. Article 5 of the IRA says that the grantor, in other words, the IRA holder, is responsible to provide that to the custodian so that the custodian can do their job. Some institutions, you may say, do not require that. And the reason for that is because some institutions all offer their own investments to be held under an IRA. So therefore, they already have the fair market value. In other words, such as broker-dealers who have stocks, bonds, mutual fund companies. If it's a bank, you have CDs, money market accounts. They already have the balance on that. That's why there's no request to the IRA holder. But self-directed accounts in which the IRA holder chose the investment to be held under an IRA must provide that fair market value to the IRA custodian so that the IRA custodian can do their duties with the IRS. Again, that's Article 5 of the IRA document that was signed in the creation of the IRA trust. In other words, the IRA document that creates the IRA on behalf of the individual. So in other words, don't be surprised if there's a request coming from the custodians that of self-directed accounts that they need the fair market value of an IRA asset. As an example, pieces of real estate, whether it be LLCs that are held under a retirement plan, a private placement, a note, whatever it is that's being held under an IRA, the custodian needs that information to satisfy their IRS reporting requirements with the IRS. Last but not least, and then we'll open up the phone lines for any questions you may have. Individuals who like the Roth IRA, which, by the way, we talked about that earlier already, because the benefits of a Roth IRA is the fact that distributions eventually will be tax-free. In other words, if you've had a Roth for 5 years, as well as one of the four, death, disability, attainment of 59.5, or up to $10,000 of the earnings for purchasing a principal residence. Well, the tax-free distribution is not available in a traditional. So some of them would say, I like that Roth. How do I move my traditional IRA to a Roth? Well, Congress says you can do a Roth conversion. In other words, a conversion basically mechanically is a distribution from the traditional IRA and placed as a contribution to the Roth IRA as a conversion. Now, keep in mind, when you're going to convert, I mentioned that word taxed. When you take a distribution from your traditional IRA, it is going to be subject to tax in the year of the conversion. In other words, that amount is going to be includable as taxable income. So be prepared that there will be taxes on that. Now, you can't undo a conversion. In other words, the moment you convert, it's done. So make sure that you know what you're going to convert if you're going to convert from a traditional to a Roth. That amount, however, is not subject to the early distribution penalty, regardless of how old you are. So in other words, if an individual is age 35 and they want to do a conversion to a Roth, although typically a distribution from a traditional is subject to the early distribution penalty of 10%, conversions, Roth conversions, any amount moved from the traditional to the Roth will be exempt from the 10% penalty. So in other words, it's a way to, number one, not only reduce taxation on the back end, but it's also a way to eliminate the early distribution penalty when you're converting from a traditional to a Roth IRA, so regardless of how old you are. As an example, if you have assets that have been converted already, well, those assets have been taxed already. After 5 years, that Roth conversion amount is not only exempt from taxation, it's also exempt from the penalty. But before the 5 years, if an individual is using it to purchase a primary residence or first-time home, or they're going to use it for education purposes, medical expenses, whatever it may be that they're eligible for the exemptions to the 10% penalty, that conversion amount is not only tax-free, but also penalty-free. And eventually, the earnings of those conversions that are sitting in a Roth after 5 years, and one of the four qualifying factors that I mentioned, death, disability, attainment of 59.5, or up to 10,000 first-time home purchase, well, then those earnings will be tax-free upon satisfaction of those particular requirements. Now, when is the deadline to convert? The deadline to convert, and the reason why we're talking about that is because we're fast approaching year end. The deadline to convert will be determined by the distribution. The year of the conversion is associated with the year in which the distribution takes place. So in other words, if somebody wants to convert their IRAs, traditional IRAs, to a Roth IRA, well, they have to take the distribution by December 31st of 2019. Now, why would they want to convert? Another benefit of conversions is the fact that once assets are converted and sitting in a Roth IRAs are not subject to required minimum distributions while the IRA holder is alive. In other words, if the IRA holder converted their assets from a traditional to the Roth, which, by the way, an RMD cannot be converted, so you have to satisfy your RMD first before converting any amounts above that to a Roth. The Roth assets that are sitting in a Roth IRA are not subject to required minimum distributions while the IRA holder is alive. You know what that means? You know what happens when a person is 74 years old and they have a Roth? You know what happens? The answer is nothing. In other words, they're not going to be required to take any sort of distribution. And they can allow for those assets to grow tax deferred, and eventually will be distributed tax free, not just for themselves, but also for their beneficiaries. And that's one of the reasons why individuals convert their traditional to a Roth. Also, in a Roth IRA, if it's tax-free, then that distribution, given the fact of its tax-free nature, will not will not have any effect on any other benefits that they may have, including Social Security. That is different than a traditional IRA. So Roth conversions are an essential tool for not only estate planning, but also for retirement planning. So if you're going to retire and you don't want to take a required minimum distribution because you're just living off, let's say, the earnings on your Roth, earnings on your retirement plans, in a Roth IRA, eventually those earnings will not only be distributed tax-free, you will also not be subject to required minimum distributions. But in order to convert in 2019, the distribution has to occur in 2019. Even if the assets hit the Roth in 2020, that conversion still counted for 2019 if the distribution occurred in 2019. Now, for those of you who do not have an IRA with the Entrust Group, I have to give you an opportunity to find out how to set up an IRA with the Entrust Group. To open up an Entrust account, all thing we need under the Patriot Act is you need to complete an application, of course, which establishes the IRA trust. In other words, documents to establish your IRA. We need to know that you are who you say you are. In other words, under the Patriot Act, you need to provide us some identification, as well as you also would need to sign our general fee disclosure. The general fee disclosure outlines all the fees we would charge, and you need to sign that form because we need to know that you agree that you need to pay us for whatever services we need to provide. All right, I'm being upfront with that. We don't do this for free. So sign the IRA document as well as the general fee disclosure. Now, how do you prove you are who you say you are? Here are some common primary identification according to the Patriot Act: driver's license, a passport, though, in other words, a current passport, a current driver's license with your picture, which will include your date of birth, so on and so forth. A Social Security number, so that we can run the background checks required by us, by law, to make sure that you are able to set up an account at the Entrust Group. Now, with that said, the account is established. Well, how do you start investing? Well, you're going to have to fund the account. In other words, there's got to be money in the account to direct us to invest in whatever particular investment you choose to invest in. Now, the most common way to fund an account is contributions. Maximum contribution, as an example, is $6,000 plus an additional $1,000 if you are age 50 and over. However, with that small dollar figure, there's typically not a whole lot of pieces of real estate, as an example, that you can buy. So most of the funding on an Entrust IRA account comes from other IRAs that you already have established and have accumulated. In other words, other contributions that have been made to other IRAs, as well as any IRAs that contain maybe a direct rollover from a 401k plan of a previous employer, or a direct rollover directly from a previous employer's 401k plan, 403b, or governmental 457b plan to your Entrust IRA. So in other words, dollars that have been contributed within the limits in plans can be moved, or in other words, can either be directly rolled over from a 401k plan or transferred. Now, keep in mind, I'm being a word police here. If it's a 401k plan, it's called a direct rollover. If it's another IRA of the same type, it's what we call a transfer. Those assets can be moved into your Entrust account, and I highly recommend only move the amounts that you are going to use to invest in that particular investment, because the Entrust Group does not offer any investments at all. If you move more assets into an Entrust account, we don't have any investments to offer you. It's just going to sit in a non-interest-bearing checking account. So move whatever you can move, and then from there, you can direct us, step three, to purchase your asset. In other words, you'll give us the authority to be able to purchase an asset on behalf of your instructions for your IRA. So in other words, you must direct us to purchase an asset. So it's 3 steps. 1, open up an Entrust account. 2, fund your account via direct rollover from a 401k plan, 403b, or governmental 457b plan. Those are just the common plans. Or transfer from another IRA of the same type, traditional to traditional, Roth to Roth, simple to simple. And last but not least, Once the account is funded, you can just direct us. In other words, Entrust, I want to direct you to purchase a piece of real estate, or you direct us to fund a particular note that you want to give to a third party, with whatever interest rate. So in other words, at the Entrust Group, it's an open architecture model. We don't offer any investments. However, you, the IRA holder, gets to choose the investment you choose to hold under your retirement plan, of course, as long as it's allowable under law. Now, I've given you a lot of information. What we're going to do now is open up the lines for any questions you may have in regards to the materials presented. Okay? And have a few questions here, starting off with the very first one. First one is a professional appraiser required for the year-end property value assessment for self-managed real estate? In other words, do you need an appraiser? That would be the most conservative approach to get a fair market value. But keep in mind, the most conservative approach isn't always necessarily required. We have certain parameters at the Entrust Group that we will accept other forms of valuation as long as there is no taxable distribution that's going to be required. All right. In other words, for example, the real estate assessment value may be used as a fair market value if there's no distribution or calculation for a distribution that would be required. However, if you want an appraisal, that would be the most acceptable form. However, contrary to that, if you want to take a distribution or you want to do a conversion, which requires taxation, or if you're in required minimum distribution state and you want the true required minimum distribution amount to be calculated on behalf of your IRA, well then the most conservative approach would be to get an appraisal. Appraisal is a little bit expensive, and as a matter of fact, if what is an appraisal required for a distribution? For other purposes, such as gifting, the IRS says if the value of an investment is more than $5,000, it is required to have an appraisal. In other words, if you're going to gift a car to a charitable institution, an appraisal is required, right? So we follow the same parameters that the IRS uses for other things to acquire fair market value. So to answer your question, is an appraisal always required? The answer is no. You can use other forms of value as long as the purpose that it's being used for is not for taxation of a distribution or calculation of a required minimum distribution. I hope that answered your question. All right. Do year-end assessments need to be sent to anyone, or are they? Well, it needs to be sent to your custodian so that they can satisfy their IRS reporting responsibilities, such as if you have a piece of real estate, you need to provide us the fair market value of the real estate at the end of the year so that us, the Entrust Group, can satisfy, number one, fair market value statement, and number two, that same fair market value is reported to the IRS on what we call an IRS Form 5498. Box 5 of the 5498 will show the fair market value of an individual's IRA, and that's where that dollar figure is used for. But again, if it's only for fair market value purposes, for reporting purposes, and it's not for taxable distributions, as an example, well then other forms can be used. But we need that fair market value on a yearly basis. Now, what if we don't get a fair market value? Well, then the Entrust Group will just report the last known value of a person's asset that was provided to us by the IRA holder. All right, here we go. What are more? Okay, if not 70 and a half, but draw Social Security, can I still withdraw some amount? Actually, the question is, if you're not 70 and a half and you're collecting Social Security and you want to take some money out of your IRA, say go ahead. I mean, you can take money out of an IRA at any time. It's just that when you reach 70 and a half, there's going to be there's going to be a mandatory amount that needs to be distributed, and if not distributed, there's a 50% penalty. Now, keep in mind, however, Taxable distributions out of an IRA will increase the taxable amount reported in your IRS Form 1040. This is where your tax advisor needs to come in. If you take an IRA distribution, depending upon your taxable income for the year, may affect the taxability of Social Security. There's a particular income threshold that Social Security recipients can receive without subjecting their Social Security to income tax. It's different for a single individual, and it's different for a married couple filing a joint tax return. It's around 26 to 28,000 for a single. It's around 36,000. I believe that's the amount for a married couple filing a joint tax return. If your taxable income increases above that, which your IRA distribution will be included in that amount, it could subject your Social Security to income tax. So that would be something that you might want to check with your tax advisor. All right. I hope that answers your question. Here's another question. If yes, can I withdraw to fund my currency broker? Sure, you can do whatever you want to do with your assets that you've distributed from your IRA. You can fund any other retail account, in other words, taxable account at that point if you would like. Distribution from a traditional IRA can also be used to fund your Roth IRA. And if your Roth IRA has a currency broker, in other words, foreign exchange broker, will then keep your assets tax deferred as well. So that's another way to do that. That's another thing that you can do. Right. Here's the next question. So if I switch my IRA to a Roth IRA at age 59 and a half, I will not have to pay taxes? That's not true. If you convert from your traditional IRA to a Roth IRA at age 59 and a half, conversions, which I mentioned earlier, is subject to a tax, but exempt from a 10% penalty. Again, conversions are subject to a tax. The initial distribution from the traditional IRA is subject to a tax as it's converted to a Roth. Now keep in mind, the assets that are contributed to a Roth are going to be what we call after-tax dollars, or taxed dollars already. So you might want to keep track of those dollars sitting in the Roth IRA. Why is that? Because if you paid taxes in it already, it'll be prudent to keep track of it. That's using the IRS Form 8606. That's where the tax advisor comes in again. And you need to file that form in the year of the conversion to keep track of those dollars that have been taxed already. After 5 years, the earnings on that conversion, not only the conversion, but the earnings also will be tax-free. Why is that? Because you've had a Roth for 5 years and you're age 59 and a half. See, in other words, conversions are taxable, right? But regardless of whether or not you're 59 and a half or not, you can even be younger, there is no penalty for the conversion. As it sits in a Roth, the earnings or the growth will be tax deferred, but eventually be tax-free the moment you have had a Roth for 5 years and attain one of the four: death, disability, attainment of 59 and a half, as well as up to 10,000 purchasing a primary residence. I hope that makes sense to you, and I hope I answered your question. Here's the next question. At what age do minimum distribution requirements start? That's a great question. In a traditional IRA, that age is the age 70 and a half. So if you're going to turn 70 in February of a particular year, you know you're going to turn 70 and a half that year. That's the year that you need to start taking required minimum distributions. And for the first year, you can postpone your deadline up until April 1st of the year following the age 70 and a half year. So in other words, if you turn 70 and a half as an example in 2019, your first required minimum distribution is April 1st of 2020. However, if you postpone your first year, keep in mind there's another one in that same year, because typically the deadline is December 31st of every year. All right. So to answer your question, the age in which required minimum distributions will begin is the year in which you turn 70 and a half. Now you might ask the question, what if I don't turn 70 until October? Well, you're not turning 70 and a half that year, but you'll be turning 70 and a half in the following year. So that means that will be the year in which you will start your required minimum distribution. So it's better to be born in the latter half of the year. Because if you're born in the first half of the year, then you know you're going to have an RMD that year. Okay, here's another question that I have. Do I have to complete a fair market value form if my checkbook LLC only contains the following: cash, Bitcoin, gold, cryptocurrency? The answer is yes, because the value of the IRA's membership with that LLC needs to be reported on that fair market value form. So that has to be presented. That has to be reported to the IRS. And by the way, if the investment is an LLC, the custodian would also have to tell the IRS that this IRA doesn't have a readily determinable value. And there is a code that the custodian would need to report to the IRS that this is a non-traditional type of investment. And that's on line 15A and 15B, I believe, in an IRS form 5498. So to answer your question, do I have to complete a fair market value form? The answer is yes. You need to tell the custodian what is the value of the IRA's membership. In some case, it's 100% membership with that LLC, so that the that fair market value will be reported on the IRS form 5498 on the value of that LLC. If that's the only investment. If there are just other investment, those need to be added as well. All right. All right. We are fast approaching noon. Here's another question. Can I distribute my contribution only, not growth, without penalty after 5 years of my contribution? There's some confusions. Some often say it is subject to 10% penalty, but others say as long as the 5-year period is met and distribute only the contribution would not be subject to the 10% penalty. I appreciate your insight. Let me actually demystify that for you. There's a lot of misinformation going on out there, and I'm also assuming that your question is in regards to a Roth IRA. All right? We're going to assume that your question is in regards to a Roth IRA. Contributions in a Roth IRA can be distributed at any time, no tax, no penalty. So in other words, if you make a $6,000 contribution to a Roth, that $6,000 can also be distributed at any time, no tax, no penalty. In other words, the whole 5-year bit does not apply. All right? So for people that says for contributions, you must have had the contribution there for 5 years, that's wrong. Contributions do not have any sort of requirement over it to be distributed. As a matter of fact, in a Roth IRA, distributions work in what we call the ordering rules. Whatever contributions you've made in all your Roth IRAs, contributions are distributed first. In other words, keep track of your IRS form 5498 to track all contributions that you've made to all of your Roths in the United States, because those can be distributed first. Now, you didn't ask this on your question, but I'm going to take your question a step further. What about conversions? Conversions are always tax-free also at any time. Why is that? Because conversions have already been taxed in the year of conversion. As long as you're tracking it using the IRS form 8606, conversions are always tax-free. However, if you're under age 59 and a half and you haven't had the conversion amount in a Roth IRA for 5 years, the conversion could be subject to a 10% penalty. What do I say could be? The reason for that is, let's say you're taking the conversion. Let's say you've taken all contributions and now you're touching the conversion dollars. Conversion dollars may be exempt from a 10% penalty, such as education. If you want to take the distribution for higher level education for yourself, your spouse, your child, your grandchild, or even your spouse's grandchild, the distribution of the conversion is penalty free. However, if you don't qualify for one of the exemptions to the 10% penalty, and you're under age 59 and a half, and you haven't had the Roth conversion in a Roth IRA for 5 years, although the Roth conversion is subject to a tax, will not be subject to a tax, it could be subject to a penalty. Now, lastly, the only thing that the 5-year clock and death, disability, 59 and a half, and purchase of a primary residence applies to are the earnings. But going back to your question, can you distribute your contributions at any time in a Roth IRA? The answer is absolutely. Absolutely. You don't have to satisfy any 5-year clock. There's no penalty on conversions because it's already been taxed already, so on and so forth. Some people are actually using their some people are actually using their contributions to a Roth IRA as a means of saving up for education for their child. Why is that? Because number one, it's not under the child's name, and for FAFSA, if there's an account under the child's name, it actually hurts the child. So they put it under the parent's name. So therefore, because eventually, if the child wants to go to college, that amount can actually be distributed and actually used to pay for education. And if you're only taking contributions, those can be distributed at any time. All right. Another question: what is a private placement? A private placement is an investment for startups under Section 504, 505, and 506 of the Securities and Exchange Commission. Which, by the way, to find out more about investments, you can actually go to the SEC website, sec.gov, and then go into the investors.gov portion of their website. They'll talk about different types of investments that are available out there, and some of them, most of them, actually can be held under an IRA, and one of them is a private placement. If a company would like to raise capital and they don't want to register the investment with the SEC, they could either raise capital on a limited amount, a moderately limited amount, or a large amount. In other words, 1 million, 5 million, and 10 million and up, depending upon, of course, the amount of capital they want to raise. They must talk to more astute investors, financially astute investors. In other words, investors that are financially smart. And how do you prove they're financially smart? They have what we call a definition called an accredited investor. By virtue of your net worth, the amount of income that you have every year, so on and so forth, the SEC has created some parameters that defines who an accredited investor is. If you're an accredited investor, companies can basically offer an investment to you called a private placement. Private placement can either be an entity that's raising $1 million in capital, or $5 million in capital, or 10 million and up. So based on whatever their criteria is, a private placement is nothing more than a company or an entity that is raising capital for their business. And that's where an IRA comes in, because an IRA could actually invest in a private placement if the IRA holder thinks that private placement will actually be successful. Right? So if you want more information about different types of investments, the SEC Securities and Exchange Commission is a great source of information, sec.gov, since they're a governmental entity, or investor.gov, which is a part of the SEC's website. That's a good place to get more information about that and explore those types of, and vet out those types of investments with your competent tax, legal, or financial advisor. I hope that answers your question. All right. Do RMDs made to a donor direct fund rather than directly to a 501c3 qualify for the exclusion from current year income? In other words, if your question is, can an RMD paid to an entity be automatically excluded for current year income? If it's a qualified charitable institution, it will be included in income. Now, again, we're not investment advisors. If it's if you're saying a donor direct, check with your tax or legal advisor. Then you folks could explore the tax exemption eligibility for that contribution to that donor direct fund. Then we don't explore it any further than this conversation. I hope that makes sense. All right. Next question: how do I get a fair market value from a CrowdStreet account? Are relationships between TEG and CrowdStreet already transfer the fair market value? That will be a good question for the CrowdStreet provider. All we do is offer the platform to invest in a particular investment, but we do not, in most of the time, we do not have that fair market value. I would say give that CrowdStreet provider a call to find out what the fair market value is, and they'll be able to shed more light in regards to how the Entrust Group gets the fair market value of that particular investment. All right. What happens to my self-directed account if I'm able to provide a current year fair market value? Well, the answer would be we will report whatever last fair market value we received from you, the IRA holder. Now, keep in mind, in some cases, some custodians resign also if they fail to receive the necessary information to do their job. Because if custodians consistently do not receive the fair market value required for the custodian to do their job, they might have to quit as their custodian and therefore resign as a custodian. So it is essential that the IRA holder does their proper due diligence to be able to get that fair market value, because all IRAs have a fair market value requirement. If not, then the last known fair market value for that IRA will be what the custodian will report. Now, some people will say, what if that asset has been devalued? Well, then provide a current fair market value, then we can devalue the IRA. Because if not, any distributions that occur prospectively will have that old fair market value on it. And if you say it's too much, well, then you'll get taxed higher on that. There's another recourse, though. There's an IRS Form 4852 that the taxpayer could actually complete, disputing the fair market value reported on an IRS Form 1099-R. But at that point, the IRS reserves the right to say to the IRA holder, prove why the amount that you're disputing is actually lower than what the custodian provided. So the moral of the story is, try to get the fair market value so that the custodian can do their job and report the correct fair market value of an IRA. Okay, here's another question. Good question here. Can an inherited IRA be converted to a Roth? An inherited IRA cannot be converted to a Roth. Why is that? Because it's not allowed under Section 408 of the Internal Revenue Code. In other words, Congress does not allow for inherited IRAs to be converted. However, if you have an inherited 401k plan, in other words, somebody died and you inherit an account within a 401k plan that you inherited from a deceased 401k plan participant, that amount can not only be rolled into an inherited IRA, it can also be converted to an inherited Roth account. But to answer your question, can an inherited IRA be converted to a Roth? The answer is unfortunately no. There are legislative proposals out there by the Health Committee. In other words, Health, Education, Labor, and Pensions, comprised of 4 senators, 2 Democrats, 2 Republicans, that basically manage the health and wealth of health plans, education plans, pension plans, and labor plans. And one of the recommendations is to allow for rollovers from inherited IRAs to another inherited IRA, which could possibly include the conversions of inherited IRAs to an inherited Roth. But that has not passed yet. So, but there are proposals out there, just to let you know. All right. Does this information about IRAs pertain to self-directed 401k plans? The answer is, some of them do, but there's a variation in self-directed 401k plans. As an example, in a self-directed 401k plan, if the plan does not allow for conversions, then there's no conversion, so it doesn't apply to a self-directed 401k plan. Anyway, that's the only one I can think of at the moment. But so to let you know, a lot of these rules do apply to IRAs and self-directed 401k plans, but there are variations on what applies. All right. Another question: if the beneficiary is deceased, is the deceased estate, and the estate doesn't know about the brokerage IRA for many years, 10, 15 years, or after death, for example, can they approach the IRS for a waiver of the penalty? Absolutely. You can approach the IRS for a waiver of the 50% penalty. And as I mentioned in the presentation, some beneficiaries do not even know they're beneficiaries. So how are they going to know to set up the accounts, right? So let alone provide the death certificate to the brokerage firm, as an example, or the IRA custodian. But typically it doesn't get prolonged for 10 to 15 years. Why is that? Because there are fees that need to get paid. If fees are not paid to that account, typically there's an initial contact that happens from the custodian or trustee of the IRA with the IRA holder. And if mail comes back, that typically gives an indication that there's something going on with the account in an IRA, especially if the person's over 70 and a half. But to answer your question, if there's a 50% penalty, that if the 50% penalty is associated with something such as a beneficiary distribution, and the beneficiary could truthfully say that they didn't know that there was an IRA there, that is a good cause, a reasonable cause, to request a waiver of the 50% penalty with the IRS. I hope that answers your question. Here's a fundamental question that is easy to answer. How is an RMD calculated? A required minimum distribution is calculated as follows. We will take the prior year end balance. In other words, if it's a 2019 required minimum distribution, the custodian will use the prior years. That will be the 2018 fair market value as the amount that's going to be divided. What is the divisor? The divisor is a life expectancy on a table called the Uniform Lifetime Table. The Uniform Lifetime Table can be found and acquired through an IRS publication, publication 590B. Google it. If you use Google IRS publication 590B, look for what we call the Uniform Lifetime Table. The age that would be used for the calculation is the age that the individual would attain as of their birthday that year. So if a person is 73 right now, but they're going to have a birthday before the end of the year, all right, then you would use 74, because the age that you would attain as of the birthday that year will be the age to be used on that table. Whatever that corresponding life expectancy is the factor that is used to divide last year's balance. And that's why the fair market value is important. As a matter of fact, the accurate fair market value is important to make sure that the accurate fair market value is used for the calculation. So in other words, if the amount is wrong, well then that your RMD calculation will be wrong as well, right? So to answer your question, take the prior year end balance divided by a life expectancy found on a table called the Uniform Lifetime Table, and the age that the individual would attain as their birthday for that tax year will be the life expectancy used to divide last year's fair market value to calculate the required minimum distribution. I hope that answers your question. All right. Another question here. Let's answer a couple, three more, and then it's past 12 o'clock. But you know what? Since you're here, can you talk a little bit about UBTI events related to real estate investment? Who is qualified to perform a third-party valuation on a note secured by a trust deed on California real estate, CPA, real estate broker, or bank loan? Let's ask who's qualified first. Whoever's qualified to perform a fair market valuation for non-distributable events will be anybody in that particular field that could potentially come up with an assumed value that could be used to list an investment for the market. In other words, it's not a distributable event. In other words, it's not a taxable event, so it's just for fair market value. Whether it be a tax assessor's office for the county to determine the property tax, or could it be a broker that can basically come up with comparable investments within that area. However, if it is a distributable event, the most conservative approach of getting an appraisal, in other words, in the event of a sale, would be an appraisal. Right? So that would be the most conservative approach for valuing a real estate investment. Now, what is UBTI? UBTI is what we call unrelated business taxable income. If an IRA engages in if an IRA investment engages in a trade or a business, that income from that trade or business is taxable as unrelated business taxable income. In other words, if an IRA engages in non-business related income, such as passive income, such as dividends, interest, rental income, royalties, mineral rights, those are all considered passive income. There's no UBTI. However, if an IRA invests, for example, in a company that does property development, that company is engaging in a trade or business because they're a property development company. That's how they make their money. Or a restaurant or a car dealership, as an example. Well, then the income that the IRA will receive from their portion of that particular business will be taxable to the IRA. Why? Because the IRA owning a business cannot have a competitive advantage over an individual that owns the same kind of business that's going to be taxable to them. They have to be taxed equally. The IRS got that particular or Congress got that particular thought process through tax-exempt entities, which an IRA is considered as a tax-exempt entity. Let's say a art gallery is what we call a 501c3, a tax-exempt entity because they got their tax exemption through the furtherment of the arts, as an example. If the art gallery sells postcards with the art in that art gallery, no taxation. However, let's say the art gallery rents out the art gallery for weddings, right? And of course, weddings is not furtherment of the arts. They're getting income that is not related to their tax exemption. Well, then that income is now subject to tax. That tax is what we call the unrealized business income tax, or unrealized business taxable income. Same as an IRA. If an IRA engages in a trade or a business, then that trade or business income will be subject to UBTI. That's where the tax advisor comes in, because a tax advisor can help prepare a tax return called the 990T. The 990T is filed by a tax-exempt entity that has unrelated business taxable income, which, in other words, if the IRA has to file a tax return, the IRA also have to acquire its own EIN number. You will not use the Entrust EIN number because we don't, own that, number one, that IRA. And number two, if the IRA has to file its own tax return, the IRS needs to be able to pinpoint which IRA actually filed that tax return. So therefore, the IRA has to acquire its own EIN. I hope that gives you enough high-level information on what UBTI is, as well as what are acceptable means to get a fair market value for real estate. All right? If a fee is required to obtain a fair market value, should a fair market value invoice be submitted to the Entrust group and then deducted and paid from the IRA assets? Well, this is what Revenue Ruling 86-142. It's a revenue ruling issued by the IRS. If a fee or investment fee is intrinsic to the value of a particular investment, which, by the way, you won't have to get an appraisal unless there's a piece of real estate and they know that it's intrinsic to it. Fees have to be paid out of the retirement plan. So I hope that answers your question. Can you go over the fair market value that needs to be reported at the end of the year? I just invested in October in an LLC that purchased property. Can we just purchase property? The answer is yes, but the value of that LLC needs to be reported to the IRS based on what was purchased, what the value is of that particular LLC which purchased property. Because that property, of course, I'm assuming that you invested in it because you're hoping that the value of that piece of real estate will go up, which is basically then in turn passed on to the IRA. So whatever that amount is, will need to be reported to the IRS. So that fair market value needs to be provided to the custodian. If it's just a fair market value, it's not a taxable event, right? So in other words, you're just telling the IRS, I'm doing very well with my investment. It's now worth this much. But of course, if it's a taxable distribution, there are other requirements, such as, in essence, the most conservative would be an appraisal. But if it's just for fair market value purposes, there are other methods in lieu of an appraisal. Right. I hope that answers your question. Does fair market evaluation still need to be done if the assets have not appreciated in value, are still completely privately placed and completely illiquid? In some cases, if there's no change, well then, that need to notify your custodian. There's no change in the value of a particular investment because still own the same amount, still value at the same price, and there's no increase. Just communicate. I think that's the biggest thing is communicate with the custodian. There has been no change in value. Then at least the custodian will have that indication not to change the fair market value on an account. Right. I have a traditional IRA in gold, on gold and silver. How do you do RMDs? Do I contact Entrust, initiate RMD at 17.5? Can I do a Roth conversion with my traditional after 17.5? Let's first start with your question. You're invested in gold? Required minimum distributions can be distributed in cash or in kind. So it's up to you. You want to sell the gold and distribute cash, or you can distribute the gold in kind. In other words, a portion of that gold will be distributed and made and re-registered under your name. So I hope that answers your question there first. If you're invested in gold or stocks, bonds, mutual funds, mutual funds, or whatever the value is at the point of distribution will be the amount reported as your required minimum distribution if you want to do it in kind. Or you can sell the stock, bond, mutual fund, or gold, and then whatever the cash is at that point, you can distribute the cash. It's really up to you. There's two options. Do I contact Entrust to initiate the RMD at 70.5? Yes, you do. Why is that? Because an IRA holder can distribute their RMD from any financial institution. We will not automatically distribute an RMD because what if you satisfy the RMD at another financial institution already? We do not want to cause undue tax consequences on your behalf without your request. So you would have to initiate the distribution. Right? Can I do a Roth conversion in my traditional IRA after 70.5? The answer is yes, you can, after you've satisfied the required minimum distribution. So in other words, you're 74, you have a required minimum distribution that year. Distribute the RMD first, and whatever's remaining can be converted to a Roth, and you will never have an RMD ever again while you're alive. Right. All right, hope that answers your question. What if property is not complete for fair market value? Report the best you can on what the fair market value is on that particular transaction. It may be in transit in some cases. In other words, it's going in the process of closing. But however, if you're closing on a piece of property, if there's an appraisal, then that's your fair market value at that point, because that's what a willing buyer and a willing seller would negotiate a particular piece of investment without coercion or being forced to buy a particular investment. That's the definition under the IRS. Then report the best fair market value, the most prudent fair market value you could provide the custodian. Right? Next question, about a real estate through partnership that manages real estate. I don't quite see the whole question. Anyway, I'll just skip that one and we'll answer it later on because I don't see the full question. Is there a dollar limit to the amount you can convert from a traditional to a Roth? The answer is no. Uncle Sam does not shy away from taxation, so you convert as much as you want, and there's no penalty, however. So convert as much as you want. They'll collect taxes today, hope in anticipation for you not to have to pay taxes in the future. Is there a cap on how much you can put in a Roth, or a cap on, well, let's just answer that one because that's the only portion of the question I can see. Is there a cap on how much you can put in a Roth? The answer is, for contribution purposes, there is annual contributions. But as far as conversions, there is no cap on a conversion because some conversions are already existing dollars in a traditional IRA that's being converted to a Roth. Is it in your purview to discuss unrelated business income tax implications? It sounds like there's a lot of questions on UBTI. Let's just table that question, and we will do a telephone seminar on unrelated business income tax in the future. How's that? I have private placement in my IRA. Am I correct in assuming that Entrust will contact me regarding the value? Well, we will contact you asking for the value. And if we had not already asked for that value, please provide the fair market value so we can provide the accurate fair market value in your IRA. Or in some cases, you can even go to the Entrust portal and provide the fair market value in the portal so that we can include that as a fair market value in your IRA. If I do not submit a fair market value and Entrust uses the previous known value, I didn't get the full question. We will answer that in a future response because I don't see the full question. Can a person continue to contribute the IRA following age 70.5? In a traditional IRA, no. In a Roth IRA, yes. There is no age limit on a Roth. There is an age limit on a traditional IRA. And by the way, in the year that the person turns 70.5, you can no longer contribute to a traditional IRA. I repeat, it's in the year that you turn 70.5, you can no longer contribute to a traditional. But in a Roth IRA, there is no age limit. I'm a limited partner in an LLC that has gone bankrupt. How do I determine the fair market value for the bankrupt asset? Receivership. The receiver will basically hopefully give you the fair market value of the IRA holders of the IRA's membership portion of that LLC. That will be good. That will be a good starting point on what the fair market value is. Why is that? Because there's a revenue ruling 59-60 that says there are other assets or transactions within that LLC that may provide value, such as are there receivables in the LLC? Is there property that was purchased by the LLC? Those have value. Those have to be placed into account on what the value is of the LLC that has gone bankrupt, and that has to be reported as the fair market value, right? I converted an IRA into a Roth in the spring of 2019 without fully understanding the tax impact. Can I reverse the conversion before the end, or is there a way to defer payments on the IRA to the Roth income tax? The answer is, unfortunately, Congress, under the Tax Cuts and Jobs Act, removed what we call recharacterizations. So in other words, you cannot no longer undo a conversion that you did in 2019 because that method has, or that recourse or that mechanism is no longer available. So unfortunately, I'm going to give you the answer that you cannot. What other forms besides appraisal can you use to prove the value? If it's not used for distribution purposes or calculation purposes, a broker's assessment of a particular piece of property based on comparables within an area, a tax assessor's appraisal or an assessment for a particular piece of property may also be used. So I hope that answers your question. We do have a fair market value form that actually provides a list of all the different allowable valuations that the Entrust Group will accept. If you go to the entrustgroup.com, click forms, and there you can download a form called fair market value, and that will provide for you other acceptable means that the Entrust Group will accept. So is there any tax-free conversion from an IRA to a Roth? The answer is no. You can run from taxation, but you can't hide. There's always going to have to be taxes. There's going to have to be a toll that needs to be paid called taxation to go from a traditional to a Roth. However, if you have assets in your traditional IRA has been taxed already, called non-deductible contribution basis, being tracked on an IRS Form 8606, then those bases will not be taxed because it's already been taxed already. But that's only when you have those dollars, and those dollars are the only ones that are not going to be subject to taxation. How much are required minimum distributions, and will this webinar be repeated? Okay. Required minimum distributions, again, are calculated and will be different from year to year. Use the prior year end balance divided by life expectancy multiple. If you need to find out what your required minimum distribution is, call the Entrust Group, and we'll be more than happy to assist you in calculating your required minimum distributions at the Entrust Group. If it's other IRAs that you have, other locations, I would highly recommend to contact them directly because they're the ones that carry that information. I have an LLC attached to my self-directed IRA, which holds real estate. In other words, your self-directed IRA invested in an LLC. I installed solar panels on the roof of one of the houses. Do I need to file taxes for the LLC and claim the rebate on that amount? That will be a question that you need to consult with your competent tax or legal advisor on that one. What is the maximum contribution you can make to a standard IRA? $6,000 plus an additional $1,000 for 2019. That's the question. That's the answer. What is the maximum amount you can convert to a Roth IRA in a calendar year? There is no limit to conversions because, again, those assets are already in an IRA. Did you receive my question? If beneficiaries do not have knowledge of the deceased IRA's brokerage plans for many years? Yes, I received that question. If the beneficiaries did not have, they're still subject to the minimum distributions. It just so happens that they could possibly request for a waiver of the 50% penalty for years that have gone by because of their lack of knowledge. And that's, again, is used, that again, it's actually done using the IRS Form 5329, and I believe it's Part 9. It's the back of the 5329. That's where they will put RC for reasonable cause and attach a letter to the back of that form telling the IRS what happened, and it's up to the IRS to waive the penalty if they so choose to. All right, we're almost done here. If a person has a number of IRA accounts, can RMD calculate for all accounts and withdrawn from only one account? The answer is yes. The individual can aggregate all the amounts for all RMDs and distribute it from any account or just one account if you wanted to. And typically, IRA holders we'll distribute that from the one that's liquid, as well as number two, probably yielding the least amount of earnings. All right. How long do Roth earnings need to be in a Roth to be taken out tax-free, and what documents does IRS have to check this? Well, it's not just how long. You must have had a Roth for 5 years, as well as any Roth for 5 years, as well as you have to be 59 and a half, dead, disabled, or up to $10,000 of the earnings can be distributed tax-free. So in other words, it's not just 5 years. You also must satisfy one of the four I mentioned: death, disability, 59 and a half, and up to $10,000 for first-time home purchase. All right. I hope that answers your question. If invested in a fund, Carter is fair market value fund available, weighted to the individual's investment. Well, it has to be the fair market value at December 31st on that account, on your own single particular account. All right. Easy answer to determine RMD. Most brokerage sites swap. Take 2000. If it's calculating 2019's RMD, take last year's RMD, last year's fair market value, and then divide that by the age that you would attain as of your birthday, using what we call the Uniform Lifetime Table, which is found on the back of the IRS publication 590B. Uniform, or Google it. You can Google the Uniform Lifetime Table, and once you get that, use the age that you would attain as of your birthday, whatever that multiple is, divide last year's balance, and that's your RMD for the year. Right. Can you start and fund a first-time Roth IRA plan after 70 and a half? Yes, absolutely. If it's your first, Roth IRAs can start the clock via a contribution or a conversion. Some people are never eligible for a Roth IRA because they make too much money. In other words, they're not eligible to contribute the annual contribution, but they can convert regardless how much money they make. So they can convert, and that also starts the clock, even if you've already started taking RMDs. So in other words, some people, what they do is they're required to take out a required minimum distribution for an IRA. Well, they take that distribution as their RMD. Now they have the money to be able to contribute to a Roth. Now keep in mind, you must have earned income that year to contribute. What does that mean? You must have worked and got paid. So the maximum contribution, although I say 6,000, that will be, and plus an additional one if you're over the age of 50, which makes it 7. That'll be low. That limit will be lowered down based on your earned income. If your earned income is only 2,500, you can't put 7,000. You can only put up to 2,500. All right. Hope that answers your question. All right. Well, that concludes our presentation for the day. We did go over the presumed 1 hour, and I hope I answered all your questions. And if you have further questions, please do not hesitate to call our 800 line, and one of our client service representatives should be able to provide an answer for you. If not, they will try to get an answer for you if it is a question that we are able to answer, as long as it's not a tax or legal question. My name again is John Paul Ruiz, and I thank you for attending today's seminar, and I hope you attend another seminar provided by the Entrust Group. Have a great day. Thank you.